record this computer. Yeah. So there we are.
Thanks. Sorry to interrupt. I didn't want your pearls of wisdom to get lost on without recording.
Thanks, Scott. You're so kind. What would be a co-star without, the amazing Scott reminding us to record. Anyway, so I think the main thing that I just wanted to kind of get us in the room for is last week was all about habits. This week, we're going to dive deep on portfolio construction. And one of the main themes of what we want to talk about today was just the 6 pillars that we have found or that we've learned from our multifamily office, and how they actually practically apply the 6 pillars to generational wealth in their portfolio construction. And again, to use another word, and I hope everyone's got their pens and papers out just to make sure we're taking notes. Ultimately, this is the silo or / the bucket approach. And we've got a white paper. We've got so much resources for this. We can, add so much value and just share it with everyone on the call. I'll make sure that I share the links and so on so you can download it. But, in space of just having a static document, I wanted to just kind of start a little bit of a dialogue and a little bit of conversation between myself and Scott and then everyone else on the call. And the topic of interest here is portfolio construction and how the bucket approach serves us better. Cool. Scott,
Alex, could I missed? Yeah, so I wanted to, if you don't mind, so I am driving and I've pulled over the side of the road to make sure that I didn't, from a reception perspective, you guys had me. So I think there's a couple of things I wanted to say here. So the first time we did a wealth weekend since COVID, and we were away with Anthony, and he basically said, look, you've got the 6 pillars to wealth. It'll take me about 45 minutes to present. Well, we ended up a day and a half, still talking about it. So anything that Alex shares with you or that I share with you now in the next hour, you need to understand that whenever we've done a wealth weekend, and we do 2 wealth weekends a year, and the vast majority of the entire wealth weekend, and the wealth weekend is a 3.5-day event, of which 1 day is fun, so 2.5 days is learning. And the vast majority of that 2.5 days is spent on this topic and this topic alone. How do you build a resilient portfolio that is diversified and that is personalized to each individual? So everyone is slightly different. Alex is turning 32 years old. He will have a very different portfolio construction to Alan, who is at a different stage of life, just to put it in perspective. And so what I think is important here, Alex, is that we want to share the principles, but with the understanding that it will be different. And the conversation we've had many times is that's where the family office comes in, where they sit with you at a personalized level and they go, right, Alex, what do you want? Okay, right, you've got a new girlfriend, you're thinking about this stage of life, whatever it is. And so then they help build a portfolio around you and your needs. Whereas someone who's retiring or retired is at a very different stage in a whole bunch of things based on risk, cash flow, needs, everything in between. So and there's 3 components here that are critically important. The first is that they start with the wealth EQ. So that's, and it's the triangle. And Alex, if you can find the triangle, I'd appreciate it. But the point is, it's wealth EQ. Who are you at an individual level? What do you actually, what suits you? And there's 27 different types of investment styles. Then you go to portfolio construction. And that's the principles upon which Alex and I are going to share now. So you've got the 6 pillars to wealth. Okay, and that white paper, Alex, you can maybe share it with people. Maybe just put it even in the chat for everyone. It is part of the, everyone's got access to it already, but just make it easy for people to find it. But you got the 6 pillars to wealth, and then you got the bucket approach, and the 2 overlay with each other. But basically, that is the fundamentals of how to build a solid portfolio, whether you're 30 years old or 90 years old, same thing. And then finally, you've got the asset income model, which is where now you take the personalization, you add it together with the fundamentals, and you create a personalized plan for you, the individual. Is everyone with me? So I'm imagining that triangle. You've got 3 sides to a triangle. You've got the wealth EQ, which is the personalized. You've got the portfolio construction, which is the kind of the core fundamentals. And then you've got the asset income model, which is where it's done at an individual level. Okay, so that I just want to do, that's the fundamentals. Today, we're only focusing on one piece of the 3-piece triangle, which is the portfolio construction. Like, how do you actually do it? Now, there's other pieces that we can bring on, and maybe next week, we can do it, or one of the weeks later, which was a great question that Alan asked I don't remember how long ago, 6, 12 months ago. And he said, well, how would you break down a balanced portfolio based on age, asset class, and everything? And so we went and did the research based on 50 years worth of research and everything else. And we literally have another white paper on every asset class. What should the allocation be per asset by age? Okay, so we've also got that. But for the essence of these sessions, I don't want to try and do too much every Friday because otherwise we're going to overwhelm people. And on top of that, the feedback we have from people is they want to be able to have conversations. So my suggestion is we don't go to that assets and allocation by age. We just stick with the fundamentals of the white paper that you've got, Alex. And my invitation, if you don't mind, would be to take people through the white paper. So share the screen with it. I did WhatsApp it to you yesterday. We go through the 6 fundamental pillars, and then we go through the bucket approach. Explain it in your essence, Alex. I'll add if there's anything that I think we're missing, and then I suggest we do a breakaway room and break into groups of 2 and 3, and people can discuss it.
Yeah. So I've shared screen in terms of, and I've, by the way,
it came with this. There's a
everyone,
tiny thing.
I've by the way, everyone, I've put the document in the chat for you, so you can literally just click it and download it and open it while go through it together, and then even maybe take notes or have a pen and paper next to it. So we're investing our time, so let's make sure that we actually get something from or we walk away with something, not just
Just Alex, I'm going to mute myself, and I'm going to switch my camera off because I'm driving and there's no need of looking at the roof. But I am here if you need me. Okay.
So Scott, do you want to maybe, before you do that, do you want to just maybe go through, because I just want to make sure that we're sticking on the theme. Do you want to just quickly go through and give us your 5 minutes of this, and then I can come back and I can go
Yeah,
through
that's perfect. So if we look at this document, and I'm just going to tell you where to go. So if you look there at the top there, you got section 1, which is the 6 pillars. So pillar number 1 is the time horizon. Like, how long is one investing for? Okay, so and again, you've got the different components of time. And as I said already, Alex is 32. It's a very different conversation from someone who's 65. Okay, and so that's the first piece of the puzzle. The second piece, if you just keep going down, Alex. So pillar 1 is time horizon. Just go down to the second pillar. You can see the second pillar there is risk. Okay, so like, how much risk tolerance? Some people are high risk takers, some people are low risk takers. And how much risk are you able to endure? Number 3 is asset allocation. So that's the piece of the puzzle I was just talking about. Like, which assets are you allocating? Are you more in the stock market? Are you more in property? More in gold? Or what are you actually in, basically? Number 4 is diversification. Anthony always talks about there's no free lunch in investing except for diversification. Diversification is the only free lunch that you've got in investing. Then if you go down to number 5, you can see there that number 5 is sorry, you've gone too far. No, up. No, you've gone too far.
Yeah. There we go. Personal goals.
So diversification. Then number 5 is your personal goals and outcomes. So that is Alex. Always told me he never wanted children. He's now got a new girlfriend who's a teacher, and I'm willing to bet he'll have children within the next 2 to 3 years. And so he'll start planning for school education and university and, like those sort of things, personal goals and outcomes. And then the final thing would be monitoring, measuring, and rebalancing. And that's why anyone who's part of the mastermind will know you should be checking in certainly on a quarterly basis, or at a minimum on an annual basis, and ideally on a quarterly basis, and that's where you're rebalancing your portfolio, etc. So those are the 6 pillars to wealth. Those are the standard. It doesn't matter whether you got $1 or $100 million. Those are the 6 pillars to wealth. Then if you go down, Alex, you'll see the next thing there is sorry, you've gone a bit far, is the asset income model. So it just explains what the asset income model is. So that's where we work with Calio, the family office, and they build the asset income model. And I quite like the acronym. It's AIM, asset income model. And it's like, where do you want to aim in life? Like, if you're going to have a wealth plan, where do you want to aim in life? Okay. And then the final piece of the puzzle is the bucket strategy. And that's where you've got 3 buckets. You've got income, which is where it's like 0 to 5 years. So that's investments that are focused on a time frame of 0 to 5 years. They're low risk and they focus on giving you income. Then you've got the second one, which is the essential. So that's where you can see the time frame there is 5 to 7 years. And that's a mixture of of like low risk and a bit of growth as well, and a mixture of income plus capital. Okay, and then finally you've got the last one. If you go a bit further down, which is the growth, and that's where like you'd be investing in Apple and Amazon and Facebook and the technology stocks. And if you just go one last thing, Alex. No, up. Sorry, up, 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 up. No, the other way, up or
Yeah, to
down. I don't
where?
know which way you want to go. So go back to the bucket. Go back to the picture of the bucket. Sorry, on the right there, on the right. So if you can just go over to the left. Yeah, that bucket. Sorry, it's just on my screen. So you can see the bucket strategy, which is basically the three time frames that and this is the asset allocation over time. So you can see the bucket thing there. So this explains it. And then if you just go down, Alex, just go down, just go one screen down, just to the next page. There's one thing there that's really valuable, which is the practical examples and how it sort of works, and how it kind of goes from one. You see the waterfall mechanism. So like just if you just read there, the waterfall mechanism goes as bucket one is depleted, profits are trimmed from bucket two to replenish it. As bucket two matures, growth from bucket three replenishes it. This creates a self-sustaining loop that balances short-term needs with long-term growth. And as Garth always says, if you get this right, you can build a wealth plan that allows you to live your lifestyle. Whereas most people in their retirement live based on on their means, like they basically live based on what money they've got left, and your lifestyle should be determined by what you want, not by how much money you've got, and your assets should provide for the lifestyle you want. And it's a fundamental shift, but it takes planning up front. So I don't know, Alex, if I've explained it, but that's the essence of the white paper. Like this piece of paper is only 3 pages long, but it summarizes everything in terms of the basis of what the wealthiest people in the world are doing with their financial planning.
Yeah. I think you've summarized it perfectly. I think the only five or one or two things that I would add is when we start looking at this part. Let me just quickly get to the right slide. Um, no, I can't find that. I can't find the right one now. Bear with me for a second. Oh, here we go. This one slide is actually one of my favorite slides that we actually have. Um, okay, share screen. Is this one over here? So when we start looking at portfolio construction, when you start looking at your income, your aim, life income model, your portfolio construction, and how that all works. One of the main things, and this is what Scott was referring to, what we'll do next week, is actually what type of assets should one have in your portfolio at what stages or what seasons of your wealth journey. And you can see here asset classes. So from equities to bonds to alternatives, or another word for alternatives is exotics, to commodities to cash, and also derivatives actually, and to some portfolios as well. But if you look at the screen here on the right hand side, you can see what type of difference it makes by having these different asset classes. So you see the blue. If you look at the blue, the green, the grayish, the yellows, and the orange, you can start applying it on this side as well. So your bonds, what percentage of your portfolio should be in bonds, stocks, private equity? As your risk tolerance goes lower, and as you increase your age within your investment journey, you start having diversity in different types of asset classes. And I think the main thing for me always, when we start talking about these type of things in portfolio construction, it actually becomes more relevant on what is the need that you have currently. So again, as Scott mentioned to me, at the moment, my liabilities are very low. Hopefully for a little bit longer, but soon my liabilities might increase. well, firstly in value, and also what does it actually mean over the next 6 to 12 months. So my current portfolio might need to change within the next 6 to 12 months, so that within the next 2 years I can start reaping the rewards. So I might go or lower my exposure in private equity to go into more income producing assets because I might need income. So that's kind of the theme of the portfolio construction. I mean, if you literally take that document and you even upload it into ChatGPT or Fathom, or sorry, not Fathom, Claude or Gemini, then literally, and you can say, please ask me questions to make this personalized to me, then that will also be quite a cool way of handling it and actually making it personalized for you. But yeah, I mean that's pretty much it. Any questions from anyone? Miriam, I see you got your hand up. Go for it.
Yeah, Alex, I found Scott went with it too fast and it was mostly directed towards you. I would really like to go through the document, at least from the top, and we go by it step by step if possible. And it's a very good topic. I'm enjoying this topic. It's definitely what I need. I'm so excited about it. So I would really like if we could go through it properly because I didn't understand one thing Scott spoke.
Okay, so let's use you as an example then, if you don't mind.
Sorry, Alex. Also, sorry, let me I just want to jump in there as well. I didn't intend to go through it with the detail. I was trying to show you, like, give you an overview of the framework. And if you want to go into the detail, I'd recommend that. But equally for everyone, just to show you the three parts of the document, plus the, why each one of the three parts is so important.
Yeah. So I think so the very first question, Miriam, then that's asked is time horizon. So let's use an example of what that means. So if you had to, so again, this is quite difficult to do it on in a forum like this, but the very first question, so I'm just going to keep it as simple as possible. The first question is, how much money, cash do you have currently? So that would be the first question. The second question would be, how much of your portfolio is sitting at what time horizons? So let me give you an example. Hypothetically speaking, let's say hypothetically speaking, you have $100,000 or 100,000 Rand, or let's keep it in dollars, $100,000 size of a portfolio. Of your $100,000, you have $60,000 in stuck assets or illiquid assets. So that might be a house. That might be shares in a company that is non-traded, meaning you cannot liquidate. So you can't go to someone and say, hey, I want to offer you this. Would you be willing to buy it so I can take my cash out? It's an asset that is again illiquid, so you can't realize your return. You can't take cash out of that. So that's the first let's just call it parameter that we put down, right? So that might be a house. Now, for in this example, let's just say that the house is fully paid, so you don't have any debt on it, because that's going to add a whole different level of complexity. But let's just say $60,000 is in that house and you don't owe anything on it, and you want to sell it, right? The time it takes for you to get out of that asset, again, the time horizon is not a quick time horizon. It might be, depending on the market, depending on the area, it might be in a lull, it might be in a very lucrative way of selling. But let's just argumentatively say that it might take you a year to 2 years to sell your house, which is fair. So that's a time horizon of getting 60% of your portfolio out within 2 years. So that's the first. I want to just talk about liquid and illiquid. So illiquid would be 60. Now 60%, that is. Now let's say that you have make it like $20,000 worth of your money in the stock market or some derivative of that, an indice or a fund or whatever the case might be. In this example, let's say that you can exit quite quickly. So again, let's use an example of, I don't know, let's use Facebook. Facebook is an example. You can go onto the stock market or a trading desk or through a broker and say, okay, I want to have $20,000 worth of my or $20,000, that's 20% of my portfolio in Facebook. I wouldn't, that would be quite aggressive. But anyway, let's just, in this example, we say that that is the case. You can exit that quite quickly because it's traded. So you can buy and sell, but that's also where the volatility comes in. Now that's a different behavior in a stock or a investment vehicle. So these both vehicles or both assets are vehicles to grow your wealth. The one is illiquid and will take a long period to get out of it. The other one is quite a short period where you can come in and out. But again, the volatility in the markets, in the two different asset classes or the different two types of markets are different. Again, what I said, 2 years for an exit within a property, 20 minutes or an hour, whatever, however long it takes for you to get in and out of the market. But again, it's not just you, that's the entire market that can come in and out. So when you look at, what's the place thing called Bloomberg, you can go see what the markets are doing. If you go and Google it or you go watch any graphs, it's up, down, up, down. So there's a lot of volatility in that market. So that's an example of what time horizon is. It's two asset classes, and there's many asset classes, which I can't go into there here. But the main thing that I'm trying to share here is a time horizon is how long the assets are invested in, and then also how long it will take to come out of it. So when we look at a AIM or a asset income model, we want to understand what that actually looks like. So for me, I can afford to leave my money for the next 7 to 10 years. All right, again, it might change within the next 2-3 years, but right now, at this given moment in time, in this call it caption of time, right now, I don't need to have access to cash quite quickly in the next 2 years. I can leave it for the 7 years. And again, if we look at investment cycles and so on and so forth, you're looking at an average of 7 to 9 years for a financial cycle to go through. So what does that mean? I can actually weather the storm. I can carry on. I don't need to sell my assets to get the income. I have enough income and my liabilities are low, but that might be completely different for you. You might say, I need income, and I might, if the market corrects or it goes down, I might need to sell because I might need the income from that perspective. So I've spoken quite a lot there. Maybe let me pause and just see if the time horizon makes a little bit more sense now.
Yeah, I loved it. Yeah, thank you so much. I understand it, and
Cool.
I understand this part very well.
Awesome. And then as you can see here, so I tried zooming in a little bit more, but it gets a bit fuzzy. Your age is what the main thing is here is, okay, what is your age? And then all the way to 99. What is the salary? Again, what you need to live off, and then your contributions you can make per month. And then when are you going to actually need to start withdrawing from it? So that's why the AIM model is so important. Okay, so now let's go to the second thing. Now, I kind of already touched on this within the two examples, right? The property and the shares or the stock market. Your risk appetite changes depending on your scenario. So my risk tolerance at the moment is extremely high. My portfolio can stretch and pull and stretch and pull as much as I need it to be because my liabilities are extremely low, if anything. So I can go invest in a high growth stock. I can invest in stock markets or in assets that are not going to give me an income for the next 5 to 10 years. Again, that might change, but right now I can invest in a stock that can go from $10 to $100, but I also take the risk. So if in 5 years my $10 goes to zero and the company goes belly up, then, so be it. So my risk tolerance that I can kind of endure is different to someone in your example. Again, I'm just hypothetically speaking now because I don't want to share personal information on this call. But let's just say that your market or your risk tolerance does not allow that. Let's just say you have dependencies, kids in high school or grandkids, or a mortgage, a house, a car, all of these things, all of these risk tolerances and what you can endure, you need to realize, and you need to kind of look at and say, okay, based on that, I need to actually understand that this is how much money I can risk for the next 3 to 5 years. And then from 5 to 7 years, this is how much money I'm willing to risk. But for the next 6 months, I need an emergency fund. The next 12 months, I need access to the cash. So if I need to buy a new car, or I need to put my kids through high school, or I don't know, someone breaks a leg, I will be able to endure for 12 months and then get that cash. If that does that land well? Or yeah, maybe let me try and explain it in a different way.
Yes, no, it's perfect. I love how you're explaining it. It's making sense and I understand it very well.
Cool.
I like how you said about, you looked at me as an example and can I risk it? Do I have a mortgage? Do I have education? I liked those examples that you used as well.
Cool. Yeah, and I think also here the I should have actually started out with this. Again, what I'm speaking about here is in a hypothetical world, right? None of the parameters that I'm talking about here is actual people. I am not licensed to give the financial advice. So I'm giving you an example of what we have learned from the family office. So please do take this from an educational standpoint. This is not examples that I'm suggesting you go and do. What I'm trying to give you is the philosophy that really wealthy families are applying to their portfolios. So just a caveat to that. Okay, so the next part of what we're talking about here is ultimately how important it is to diversify well when looking at your risk tolerance. So when you start looking at shares or bonds or assets, the number one thing to see here is how does that impact my lifestyle? Again, Scott mentioned a very, very important topic here. And this kind of like was a massive realization for me when Garth said this, is normally what people are taught to do or to believe is that your portfolio will dictate your lifestyle. Let me say that again. Your portfolio, again, how much money you have, will dictate your lifestyle. So if you have a portfolio that only dictates a lifestyle of $1,000, $2,000, you are stuck in that asset or in that loop, if I can put it that way. It should be other way around. So what you should be doing is saying my lifestyle, and really look at this and say, my lifestyle that I want is $5,000 to $10,000 to $20,000. Okay, then you know your number. Again, this is why I'm so passionate about know your numbers, because this is where everything starts. You know your number, your lifestyle number. Okay, so let's hypothetically say that that is $10,000. So $10,000 is the goal that you want to get to live the lifestyle that you want. That means that your portfolio, the money you have in the market, needs to be able to sustain that portfolio or that amount of money per month up until, well, let's use an example. Let's say I want a portfolio size of $10,000. Okay. That is what the lifestyle I want to live. Can my portfolio sustain that right now? No. Okay. But I don't need it to sustain that lifestyle because I have active income coming for me, which is sustaining my lifestyle. But in the next 20 to 30 years, it might be a case of I would like my portfolio to sustain that lifestyle. So I need to grow my portfolio to that point. Now, I have 20, 30 years. Many of us do not have the luxury of that. So then you start looking at, okay, based on that, I need to start taking a little bit more risk or a little less risk or more income or less income or more capital growth. Again, so we'll touch on that more next week. But I think in this graph, you can see here that the months and the years and the amount of volatility that's in the market, you need to start taking that into consideration. Again, would you like to be told what lifestyle you will have to live, or would you like to choose the lifestyle that you would like to live? I think that's the $1 million question here. And when you start looking at your portfolio from that aspect, things become very real very quickly. And that's when you start looking at, okay, I need to start taking more risk or less risk. And then I think a beautiful statement that I heard from a lady that I met with last week. Yeah, I've known her for quite a few years now, 2, 3 years maybe. I can't remember. And on the call, she said to me, that she always joins these sessions and she does this and she does that and so on and so forth. And one of the main things that she realized is before she can actually start looking at her portfolio, she actually needs to start making active income so she can start contributing towards the portfolio. Otherwise, she's dead in the water before she even begins. So she took it on her. She really kind of embraced that and started really looking at it. And within 2 years, and I can hand on heart, I did the due diligence. I checked this. So what I'm about to say is not hearsay, it's fact. I saw it. She grew her portfolio from zero to $49,000, call it $50,000 within 2 years. She grew her portfolio from zero to $50,000 within 2 years because she realized that if she doesn't take action and start getting active income to put into her portfolio, she can start reviewing the portfolio all day long and understand all these things. But if she doesn't have the dry capital or the dry powder, again, money to invest, she's dead in the water already. So it's quite a nice way to, or not a nice way, but a very real way to start looking at what you need to be making or what decisions you need to be making in your investment portfolio so that you do have that, that peace of mind that your portfolio will start taking care of you. So I spoke a lot about a lot of different themes there, but what I'd like to have really make sure lands here well for everyone on the call is it's about understanding the time horizon and understanding the risk that one takes within that time horizon to get your portfolio to a point where you're getting the lifestyle income that you deserve, not that is told by you by your portfolio or an asset manager or whatever the case might be. Okay, so let me, any questions on that, or did that land well? Cool, I'm getting a few thumbs up. Miriam, are you still with me? Have I lost you there?
No, no, I'm loving it. I want the recording of this, please. It
Cool.
is absolutely the information. I'm loving your teaching so much.
Oh, thank you.
I understand everything beautifully.
Cool. So then, I think I spoke a lot about the philosophy, but when we start practically looking what that means, it's simple. It's asset allocation. And what is asset allocation? It's what are you going to take your money, your $100 or your $200 or your $1,000, whatever it is, and where are you going to go and invest it? Now, here are, and this is ultimately then when what I said earlier is in what vehicles, again, a vehicle is something that we use to grow our wealth. We use different vehicles at different times to do different or solve different problems, right? A vehicle is just an investment, but the way an investment behaves is different to each other. So a stock market investment will behave differently than a exotic or a private equity investment. For the exact, if we go back to that example of the house versus the stock market, they behave differently, completely different. Again, a house argumentatively can actually start giving an income when you start getting a good tenant. Stock market doesn't give any income, right? They behave differently. So when you start looking at asset allocation, you start looking, okay, these are the ways that these investments are going to behave. And I'm happy to do this in this investment, this in this investment, and that in that investment, because I understand how they behave. And because I understand how they behave, I can take advantage of that. And then, well, I can't remember the gentleman's name now. What's his name? Someone help me. It's the guy that does the biggest hedge fund.
Dalio.
No, the biggest hedge fund in the
Ray
world.
Dalio.
Ray.
Ray
Yeah.
Dalio.
Yeah, thank you. Ray Dalio says any portfolio should be diversified well. Because if you're diversified well, yeah, again, that whole saying of the free lunch thing, there's no free lunch in investing. But there is a very, very good chance that you'll get a free lunch if you diversify well. And what do we mean by that? It's actually by having assets in or money or dry powder or whatever term you want to use in different assets will give you returns at different points of your wealth journey, right? So let me take a step back there. If I invest in my house, or again, to go back to that example of the house and the stock market, if the stock market tanks or goes down by, I don't know, 10, 15, 20 points, percentage, right? It goes down. But my home is paying me an income because I've got good tenants. I don't really, well, again, from my perspective, I don't really care. I might, if I can sustain it, I might actually take half of the money that I'm getting from my home and put it back in the stock market so I can dollar average it. So by the market going down, I'm buying because I can sustain that and I can afford that. So when the market returns or recovers and it goes up, my portfolio has not gone down. It has gone down again without realizing it. Realizing in the sense of I've pulled money out, not realizing I haven't watched it, right? There's two different terms. So let me just pause there. So an investment, while it is in a market or while it is in the vehicle, again, what I referred to earlier, you haven't realized your returns or your losses, right? Because it's all theoretical still. It's all in the system. It's a fugazi, it's fugazi. It doesn't exist. It's not something you can touch. It's still within the system. It only becomes realized when you click withdraw or you click with lost or you declare it. So what I'm saying is, if I take money out and I put out of my home and I put it into the stock market, I'm actually increasing my portfolio. Again, that was my choice because I can afford it. Because now I'm buying shares. Let's just say 10. Let's say for argument here that Facebook was $10 is now $5. I'm buying more value at $5 than it was at $10, right? And what I'm saying is my thesis dictates that it's going to turn and go back up. So that's the difference here. By diversifying well, you can actually take advantage of the markets going up and down because you have different assets and different investments paying your return at different intervals. So you can diversify your portfolio again to sustain your lifestyle. It comes back down to, can you sustain it? And for how long can you sustain it? Okay, I think personal goals and outcomes are quite self-explanatory. But here, again, what Scott said, my personal goals is to build my portfolio to an X amount within 20 years, okay? My goal is at least 100 to 200 million that I want my portfolio to grow at. Now, for that to be possible, I need to know, okay, I'm going to have to take a knock on income. I'm going to have to invest in businesses and stock options that are private equity that can really wash its face over the next 10 years. But the cost of that is I'm going to take a knock on income. Again, so my personal goals, personal outcomes is in 10, 20 years, I want to have a massive portfolio. But I'm very conscious that that's going to take a lot of work and active income, and it's going to cost me to invest in companies that can 10x or 20x, but they can also fall flat on its face. So I'm taking that risk based on my personal outcomes because I don't need income right now. It might change in the next 2 years. But let's say that my portfolio needs to change or my personal goals change is, okay, I need to buy a house. I need to pay for a wedding. I need to buy 2 new cars. I need to start thinking about schooling. I need to start thinking about travel, sport, all of these things. I then have to take those personal goals and life outcomes and put it into my portfolio and say, I'm going to need income. And by the reason for to sustain that kind of lifestyle, I'm going to need more income. So my goal for the next 10 years might change. I might need to take less risk, but then that affects my long-term strategy. So that's why life outcomes and life goals are so important as well. And then, yeah, let me just fly because I'm very conscious of time. I think the monitoring, measuring, and rebalancing speaks for itself, is know when to take profits. When you've gone up by 200, 300%, and the market is doing exceptionally well, you know, think of what your portfolio balancing needs to be. Again, that's the whole bucket approach that Scott referred to, is your 7 years starts replacing your 2 years. Your 2 years start replacing your 1 year. And that's ultimately how your buckets start filling up themselves. Again, so those are the key fundamentals, from time horizon to portfolio risk to life outcomes, and then how that kind of all forms part of the bigger picture effectively. So Miriam, I don't know, sorry, I'm just trying to not make this too long-winded, but also make sure that the steps are explained in a very simplistic example.
Yeah, I really found this very helpful. I understand what's portfolio. I understand that now I need to put my attention, what is needed to put my attention in. And I liked all of that. When it came to the personal goals one, the question that was, will the wealth calculator be the answer for the personal goals and outcome? That's where you use the wealth calculator.
So what the wealth, yeah, exactly. So the wealth calculator is literally what I've just explained to you. If you use that wealth calculator the way that the white papers and the videos and recordings shares, you'll be able to build your entire strategic wealth plan by yourself by just adopting that. So everything, all the steps that I spoke to you about now, the philosophies that's within that conversation has been interlinked and ingrained in that calculator. So yeah, so literally, I think we've gone quite nicely full circle here. Is if you want to understand your portfolio construction, it starts with know your numbers. Because if you know your numbers, you can start planning your time horizon. You can start planning your risk tolerance. You can start planning your what is it? Personal goals, personal outcomes, whatever the word is. Then you can start building your rebalancing, and you can have a dashboard, because it's literally all there. Your dashboard, when you're supposed to rebalance, and how that all works. So, I mean, in closing, and I'll pivot to sorry, before I pivot, Miriam, any other questions before I kind of go to that and share that what that looks like?
No, no, it's just that if in our next sessions we could go more into the bucket and the monitoring part, just in our next, just so I can get that understanding, not today, but in any other future sessions.
Cool. Okay. So let me do three things. So I'm going to firstly, or let's one thing. What is your homework for the next 7 days before we meet again? The homework is go to know your numbers and play around with this one thing here, this calculator. Because everything I spoke about today is theoretical. And if you want to make it a real thing, here everything is. And I think the main thing for me was this wealth plan. So what is your income? So I said 10,000. That means there. What is the amount of money that you need to sustain that lifestyle is here. And then what does that mean? How much money do you actually have to start investing to get to that point? Again, there is white papers, there's videos. It's literally all here. It's like how to use it is the white paper here. Print it out, have a look at it. There's a video about it that Scott did here. It's 15 minutes. It's all there. So if you want to make it personalized to you, have a look at what that calculator looks like in the white papers, because then you can do your own portfolio construction. And then next week, what we can do is we can speak about that. What is it called again? Anyway, the time, at what ages, at what age should you be investing in what asset classes? So we'll talk about that, and then we'll also just go through the bucket approach in a little bit more detail, and as well as just the life outcomes and how the calculator works. So before I close out, Scott, are you there? Are you still with us? I see you're still here. I don't know if you.
Yeah, just give me 30 seconds. I'll talk in 30 seconds.
Okay, cool. So yeah, I think that kind of covers it, folks. From portfolio construction to how to articulate or how to review these terms, time horizon, risk tolerance, portfolio construction, diversification, and personal goals. How did it kind of all weave together? Again, I've given you a resource in the chat to use. I've also suggested to go back to the school platform, have a look at the calculator, because all of these terms and all of these things become very applicable in that one thing. And yeah, my closing statement would be, we had a great session today. Think about how to practically actually put this into motion and what to do about it. Scott.
No, listen, I two things. One is I just wanted to acknowledge you, Alex. I thought you did a great job today going through the detail. I always marvel listening to you, and I don't know if everyone else feels the same way, but a 31-year-old that can speak about this stuff more eloquently than most financial advisors. So again, just it really is interesting. So well done. And I think, Miriam, to you as well, thanks for asking for the detail. And Alex, I think you, again, did a splendid job using real people, real stories, and going into the details. So I think the learning lesson for me with these things is spend more time going through the detail. And even if one white paper takes 3 weeks, then so be it, because it's the deep understanding of this stuff that is the absolute the most critical. So yeah, well done for everyone being here. And some of these, there's 22 white papers that are part of the 6 stages that we've got, the Wealth Transformation Pack. And I promise you, if people understood each one of those 22 white papers, they would know more about finance than 99% of people on this planet. 99.9, and I include all the financial advisors.
Cool.
Right. Alex, where's the link we can go on to now to print this thing down and do some work?
I'll email it to you, Alan. I'll quickly pop it through on email, and you can print it directly onto your.
Also, if you go to sorry, Alan, Alex, if you go to Wealth Hackers, you'll see that there's a link there to the Wealth Transformation Pack. There's a whole course called that. Maybe if you could just grab that link, Alex, and just put it in the chat for everybody. And then this particular white paper is in the section 2, which is the fundamentals.
Yeah, here it is. So if you look at my screen, here's so under Wealth Hackers, into the 6 stages of wealth. If you click on that, here again, mindset and purpose, core. I think I can't remember which one.
It's the second one. It's the second one, Alex.
Core wealth principles. This one.
Yeah, and there you can see it. It's one of those ones there. The six laws to wealth. There we are, number 2.
Yeah,
number 2.
There it is. Cool. Excellent.
Okay, so you got to put that in the link, because that's the issue problem. We do all this work, and you've got so much stuff, and we need to go through this work alone.
Yeah. So here's the direct link on the chat. But I'm just going to take a screenshot as well and put it in the chat quickly for everyone. Just
okay, brilliant.
Be very clear. There we go.
I do think, Alan, I think you're spot on. I think everyone should go and read it a few times. And next week, let's start with any questions around this document. But this document is like the building blocks, the foundation. So, I think it would be very valuable as a homework task for people to go and read through it. And if there's any questions people have, let's start with that next week.
Yeah. I mean, as we...
You don't go and take this thing down. I mean, I suppose you don't know because you lecturing all the time. And you don't go through this thing, study it on your own, ask, write, so you can kick off with the next week. You will learn nothing.
Completely.
Exactly.
I've just spent 28 years learning it.
There you are.
Cool, guys.
Thank you.
Thank you, everybody.
Cool, guys.
Fantastic.
Thanks, everyone. Have a wonderful weekend, everyone.
Cheers. Bye-bye.
Cheers, brother.